And our discussant is Dr. Deepali. Dr. Tirthankar Patnaik is Chief Economist at the National Stock Exchange of India. He has over 2 decades of experience in the Indian and capital markets, academic research, credit research in macro and sector strategy, quantitative finance, and consumer finance. Dr. Patnaik started his career as a researcher at the India Institute of Development Research and worked on a number of academic and corporate projects in the area of econometrics and quantitative finance. This was followed by a stint in consumer banking analytics as analyst with the global consumer group of Citibank in India and Europe. His next focus area was equity strategy for institutional clients, initially with Citigroup Global Markets as India equity strategist, and then with India Capital Markets Limited as India strategist and chief economist. In his last assignment prior to joining NSE, he was the chief strategist and head of research at Japan-based Mizuho Bank. It's a pleasure to have you with us today, sir. Thank you for being here. Our discussant, Dr. Deepali Dixit, is a Deputy General Manager in SEBI and has around 70 years of experience in the domain of securities markets. She presently heads the Commodity Research Division of the Department of Economic and Policy Analysis in SEBI. Prior to that, she was heading Equity Research Division of SEBI, and her responsibilities include research related to commodity derivatives, organizing SEBI NISM Research Conference, inputs for various publications as SEC and calculation of SEBI. Earlier, she was involved with the publication of annual report, bulletin, development of the Financial Development Index. Dr. Mishra represented SEBI as a member of working group on protocols and procedures for enhanced cooperation under interregulatory board financing. She is a regular speaker at various investor awareness programs organized by both SEBI and NISM. Pleasure to have you with us, ma'am. Before we go on to give a presentation, I'd like to walk you through the guidelines for the presentations. A total of 15 minutes will be allotted for paper presentation, upon completion of which a bell will be rung, and post this, 2 minutes will be allotted for presenters to conclude. This will be followed by 7 to 8 minutes of discussion remarks, and an additional 5 minutes will be given for the question and answer session. And now I would like to request the Honorable Chair, Professor Dr. Tirthankar Patnaik.
Thank you, Shruti, and welcome everybody. I know it is lunch, but we promise to have a series of interesting papers which will whet your appetite for food for thought. The food for the other things can happen later. So hope you could bear with us on that front. We have a plethora of interesting papers today, 3 interesting papers. And I'm sure each of them will have something that will be non-trivial, and it will also offer insights, each of them, that will help us think about the current situation, the pandemic, and how markets have reacted to it in a better manner. So without further ado, let me invite the first author to present his paper. And I'm very sorry I could not be present today, thanks to some unavoidable exigencies. My first paper, here in the session would be by Mr. Kousik Ganguly. The paper is titled Political Connections, Firm Leverage and Cost of Capital, Evidence of Listed Firms from India. Mr. Ganguly, you're on.
Yeah. Shall I start? Shall I proceed?
Yes, please.
Thank you, sir. Yeah, is it visible?
Yes.
Okay. Thank you. The title of the paper is Political Connections, Firm Leverage and Cost of Capital, the study on the listed Indian firms. The entire survey is based on the Indian financial market or Indian stock market. Since the time is limited, so I have to restrict my presentations within 15 minutes. I try my level best. And my co-author is my supervisor of PhD, Professor Ajay Kumar Mishra from IIT Kharagpur, and Professor Pankaj Jain from University of MPs, United States. The flow of the presentation, of course, we are talking about the motivation of the study, and then followed by introduction. Then what is our contributions apart from the literature review, and then we come to the literature review. And after that, we derive the hypothesis development, and then whatever empirical analysis we have done, we discuss upon that, and finally we draw the conclusions. Now, what is the political connections? If we're talking about from the literature point of view, and we try to apply the entire thing into our study, maybe exactly in a ditto manner. Basically, any board member or the member of parliament or ministers or member of assembly, if they closely linked closely linked to any particular firms, particular company board or firm board, those company or firm are entitled as politically connected firm. And the entire innovations or the research started from the Mara Fascio 2006, that the cult paper in this particular domain. Now, there are certain features for politically connected firm. Basically, the number of independent director in the firm is relatively larger, and mostly firm belong to the regulatory sector or regulatory industry, and they are product in diversified sector. These are the sign that a firm is entitled or belong to entitled as politically connected firm based on the literature definitions. And apart from that, firm mostly larger in size in terms of asset, in terms of market capital, and also belong to the influential business family. I think this particular thing is very much pertinent to the Indian context, because we will come to know down the line that influential business family, those firms are highly influential, and those firms are directly or indirectly related to the political parties, especially the ruling parties. Now, also, firm, as I already mentioned, the more number of independent directors in the board, and also the larger number of employees. These are the signs that a firm is entitled as politically connected firm. Now, in our study, the main variable of interest is political connections. Now, apart from that, we try to segregate the political connection into two distinct channels. One is political connection via donation, another is political connection via promoter. Now, what the previous literature or past literature has done, they focus either of the channel, either by political contribution or political donation, or political connections via promoter or owner or chairman of the company. But they don't able to combine both the channel or link together and try to come or infer a very concrete study on that. So there is a research gap in the prior study. So we try to focus on that. We try to combine both the channel. One is donation channel, another is the promoter or owner or the chairman channel, by which a firm can be linked to the political parties. Now, what is the ultimate benefit from this? There are win-win situations from both the firm perspective as well as from the political party perspective. Firm perspective, based on the literature, what basically they easily get the government contract or subsidies, lower taxation rate, or access loan at a very cheap rate, at a very lower rate, soft budget constraint, and also the regulatory protections. These are the benefits that basically derived by the firm who are associated strongly with the political parties. Now, what is the benefit for the political party? Basically, firm used to carry on the funding for campaign contributions, or maybe especially during the elections, or maybe many political party put their party member into the board or influential position in a particular firm, and also by which firm also able to manipulate the policy of government policy, which is favorable to their firm also. So there are two-way benefit from both the firm perspective as well as from both the political party perspective. Now, if we come to the Indian perspective now, because since our study are basically restricted to the India, now influential business family over the year, they are strongly or indirectly or directly associated with the political party. Now, there is a direct funding used to take place by which that political party firm used to donate to the political party. But some of the leading business group in India, they able to establish the electoral trust by which they able to channelize their fund to the political party, and this has been started from 1996 via the Progressive Electoral Trust of Tata Group. Now, there is an amendment took place in 2013 by the Section 25 of Companies Act 1956, where it is being mandated that every political party need to publish their contribution report from where they able to get the funding. So they able to disclose to the Election Commission of India. So the thing become much more standardized from 2013. So all the electoral trust of leading business group or business group family, they basically publish the donation report from from what are the companies they are getting funded. Now, there are much more amendment took place in 2017 by the introduction of the finance bill, where the another tool or another instrument being introduced, which is called electoral bond. Though electoral bond data are yet to publish, maybe there are delay because of the COVID pandemic. So we have now two tools. One is electoral trust and electoral bond. Since electoral bond data are yet to publish, so in our study, basically electoral trust data is being empirically applied, and also the direct funding data are also applied. Now, our main variable of interest is connection, but as we already mentioned, there are two channels also, which is connect don, that is funding by connection by donation. Another channel is connection by promoter or connection by via owner. So connection by donation, which is already in the literature, Classinated 2008 paper and Cooperated 2008 paper, and promoter channel, which already being described, which is basically on US market, which is Bunkan Wanicha 2009 paper and FASIO 2006. FASIO paper is basically cross-country analysis, mostly the developed economics like European country as well as the American US, and also the Canada study is being covered in FASIO 2006 paper. So connect on and connect from, these are the two main variables of interest. Now, what is our contribution? As I already mentioned, that previous study either focused by donation channel or by promoter channel. So we try to combine both the channel together, by which we try to establish the political connection of any firm. Now, we have already seen that the politically connected firm in the Houston paper in 2014 and Khawaja Mian paper in 2005, that politically connected firm, they getting loan at a very lower interest rate. And Bobakri paper in 2012, which basically mentioned about that the cost of equity of the politically connected firm are significantly lower. So from there on, we try to see that cost of equity and cost of debt, because any firm get the external capital, outside capital, either by in the form of debt or in the form of equity. So we try to see whether the politically connected firm access the cost of debt and equity at a very lower rate or not. Second objective, we try to assess that in Indian market or in Indian context, since the debt is at a very lower rate, so firm usually may have the tendency to take larger amount of loan in order to run their business. So there is a significantly higher amount of leverage in its book or not. So these are the two basic objectives. Now we try to see, since the capital intensive firm, they require more amount of capital to run their business. So we try to make a robustness test. We take a separate sample which basically belong to the capital intensive industry, and we try to see whether the capital intensive firm, their leverages which are politically connected, their leverage are significantly higher or not. And lastly, we try to assess whether the politically connected firm follow the pecking order theory or not. This is a special capital structure test. Now, if I talking, so these are our contribution in our study. Now, if I talking about the literature review, I already mentioned that the Marafasio bring up the concept of politically connected firm. She basically mentioned that politically connected firm leading to higher value, higher firm value, higher market value, higher accounting value, and also has privilege of preferential access on credit. But before that, Robert Fishman, he also wrote a paper which basically restrict to the Indonesian market. He basically told that Indonesian president list of firms which are closely in contact with the Indonesian president, they take the advantage due to have a politically connected, due to have the connection with the political party. So now Marafasio in 2010 paper and Houston et al, as I already mentioned.
Kaushik, can I just tell you to skip this literature review thing and focus on what you had done and what not?
Yeah. I'll definitely discuss. I just discuss this only one slide. Please allow me, madam. Then I'll move ahead. Okay, ma'am. So next, so Houston et al in 2014 and 2009, 2005, Khawajamian, they basically told that politically connected firm avail loan at a very cheap rate, and the cost of equity of the politically connected firm Bobakri et al posit in 2012. So these are the study has already been done. So as I already mentioned that our study is to join both the hypotheses together, that the cost of debt and cost of equity are both lower for politically connected firm. From there on, we come into conclusion that the cost of capital of the politically connected firm are lower or not. So we derive two hypotheses here, that politically connected firm have lower cost of debt, that is preferential access to credit, and second is politically connected firm have lower cost of equity. And the third hypothesis that I already mentioned, that Bliss and Gould and other previous author that mentioned that due to have loan at a very significantly lower rate, the leverage in the book is significantly higher for the politically connected firm. From there on, we can derive another hypothesis that politically connected firm are positively associated with the firm leverage. And the fourth hypothesis, we basically mentioned that politically connected firm do not follow the pecking order theory. Why we posit this kind of hypothesis? In the upcoming slide, we discuss on that. Before that, we draw this diagram based on our data from 2009 to 2019 of 11 years of data. In the left-hand side, we basically we clearly see that the leverage of the yellow sign, which is the connected politically connected firm via promoter, and also the saffron, which is the overall politically connected firm, their leverage, quantum of leverage are significantly higher in comparison to the blue bar graph, which is the politically non-connected firm. So their leverage are relatively lower in comparison to the politically connected firm. On the right hand side figure, we basically plot especially for the capital intensive firm, and we see the similar kind of result, that yes, for the capital intensive politically connected firm, the promoter channel and also the donation channel politically connected firm, their leverage is significantly higher. And if you see the right hand side blue bar graph are significantly lower in comparison to the left hand side blue, because they are the capital intensive non politically connected firm, so their leverage quantum are far lower in comparison to the connected firm. Now come to the pecking order theory. The pecking order theory basically proposed Myers in 1984 in Capital Structure Puzzle. He basically he basically posits that there are three different ways by which capital can be drawn. One is return earning, which is the internal capital, and another is debt, another is equity. So firm giving more importance to the internal capital or return earning in comparison to the equity or debt. But return earning do not have adverse selection problem. There is no information asymmetry. But equity debt have significantly higher information asymmetry. But small size firm do not follow the pecking order theory, which basically posited by Frank Bell in 2003 and Shyam Sundar in 1999. So what it means? So if you see over the period of time, more small size firm getting listed into the market, maybe most in the US market as well as in the Indian market. So that's why the relevance of pecking order theory become deteriorated over the period of time, because of the small size firm listed in the financial market or in the stock market. So from there on, we can posit the hypothesis that pecking order theory, politically connected firm do not follow the pecking order theory. Now our surveys basically follow the NSE listed firm of 1834 firms, and politically connected data we basically collected from the Election Commission of India website, and the entire survey is listed from 2008 to 2019, and we basically exclude the PSU firm and also the housing finance insurance firm and broking firm in our study, from our study. So these are the five equations we basically derive. Cost of debt, COD. COD is basically cost of equity. This is our outcome variable. Leverage is LEV. Now, these are the variable definitions. I do not go into broad. It is clearly mentioned in my paper because of the time constraint. Now the model we have run. First model, as I already mentioned, this is the cost of debt. The first equation, the equation 1. We clearly see that the coefficient of connect are significantly lower for connect in both single and full run model, and also the connect down and connect from donation channel and promoter channel also statistically significant and coefficient are negative. So from here on, we can posit that yes, politically connected firm tend to have lower cost of debt in comparison to the non-connected firm. Now this table basically display the cost of equity part. Similar consistent result we find that the coefficient is negative and statistically significant for connect as well as the connect down and connect from. So from here on, we can posit that politically connected firm have lower cost of equity also, and we controlling the firm fixed rate and year fixed rate as well in all the model.
So you have 2 minutes for conclusion.
Okay, madam. Now this is the leverage part that we see the connect is positive and statistically significant, and here the connect from is positive and statistically significant. So what we can derive that politically connected from have higher amount of leverage in its book. Now we run a special sample, as you mentioned. We take only the capital intensive firm and try to run a robustness test here, and we see the coefficient is much more significantly higher here, 19.5% in comparison to the 2% here. So it means that capital intensive politically connected firm, they derive more amount of loan at a very lower rate from the banks and getting more advantage because of the political connections. Now here in this test, we basically try the endogeneity test. As I already mentioned, the politically connected firm has larger number of employees. So we take employee as an instrumental variable and try to see whether it satisfies the previous empirical analysis. So we clearly see that connect is statistically significant and positive coefficient, and for COD, cost of debt, the connect is negative and statistically significant. So our test here using the instrument, the endogeneity problem is categorically cleared and consistent with our earlier study. Now the last only result, that is a pecking order part. The left hand side display the politically connected firm, and the right hand side the non-connected firm. For politically connected firm, we clearly see the DEF, which is the outcome variable, which is 20.6% and 13%, which is relatively larger than the politically non-connected firm coefficient, which is 11.5% and 12%. What it means that none of the coefficient exceed the 50% mark. So it means that either politically connected firm or non-connected firm, none of them follow the pecking order theory. From here we can proceed that. So ultimately we conclude that yes, the firm basically influencing because of the political association with the political connections. That's why their cost of capital is significantly lower because of cost of data lower and cost of equity are lower, and because of the lower cost of capital, their leverage is significantly higher in comparison to the non-connected firm. And the same thing is being consistent for the capital intensive firm as well. And we also saw that politically connected firm do not support the pecking order theory, and I already explained the justification for that. So thank you from my side.
Thank you, Kousik, for a quick presentation. And although yeah, it seems very, very interesting. May I now call upon Dr. Dixit to discuss the paper?
Kousik, let me congratulate you first. It was really a good topic to study, very different from what we are actually going through in a routine manner. What we are seeing Kousik, I am congratulating you to select a very different topic of study. It is generally different from whatever the research topics are taken up generally. We have been dividing the literature into very, very different areas of studies. And the data is also chosen very carefully, which sample is to be excluded, what is to be included. I was wondering actually before I saw your presentation how you got the data for the politically connected firms. And now, since you told us that you have taken that data from the Electoral Commission of India, I saw that you collected the data for 1,836 firms. So how do I actually proceed? You first went to the Commission's website and see what are the political people who are having connections with the firms. So it was selected the firms and then go and went back to see the political connection. How you selected that data?
Okay, donation data we clearly got from the Election Commission of India side, and if you follow the leading political party, they annually publish the contribution report of all the leading firms, and from where you can easily get the donation data. And for the promoter data, we basically got from the board of the firms, and lot of firms, they are either the MP or MLA are directly, indirectly associated with the firm. From there on, we easily got the promoter data. And if you ask me, I'll give you the name of those company with all the details.
I'm not doubting. It was a query actually. Now I'm having a simple query regarding your methodology and etc. Mr. Tirthankar Patnaik would be asking you the relevant questions. I'm having a question from a practitioner point of view. I just don't get the difference between what you have mentioned on page number 12 and page number 15. of your paper. If you have your paper open in front of you.
Okay. Yeah, sure.
On page number 12, I may read it. The firms connected through promoter channels maintain a higher level of leverage in comparison to connected firms via donation limits. And again, on page 15, you are writing that we observe among the politically connected firms that the firm connected to promoter channels value high, maintain large cash, and are smaller in size and low leveraged. So at one place you are telling high leveraged, and at other place you are telling low leveraged. So I got little.
Okay. I clearly telling you, ma'am. The promoter channel firm as well as donation channel firm both have higher amount of leverage. Those are politically connected. Now there is another study we have done externally that which is a size effect. That small size firm, they taking more influence from the political connection, or large size firm, they taking more influence of political connection. From there on, we take a separate sample for the size, and we come to conclusion that the small size firm, those are the connected by promoter, they taking higher amount of advantage because advantage or benefit because of the association of the political party. That analysis we didn't put in these particular presentations. Maybe that is written in the paper, but we have done that analysis as well.
It is really a good paper, Kaushik, and I think whatever is the common understanding that political connected firms may be getting some preferential treatment, you just technically supported the prevalent common belief. And it's just one suggestion I am writing. I just saw your presentation where you had made a statement like some corporate houses are having some political connections. It's just a suggestion that in a research paper or anything which we are going to write, if you are writing such statements, it should be backed by facts and figures or reports. Simply writing such things is not a researcher's way of writing the paper. It's just a suggestion, you can take it. Otherwise, I find the paper very good. Congratulations to you. Over to Tirthankar sir for his comments.
Okay. Thank you, Dr. Dixit. Good paper, Kaushik. Very sensitive subject and good analysis there. I had a couple of questions though. I would echo Dr. Dixit's views in terms of political connectedness. I also noticed at the end of the paper, you provided, the sort of in the appendix, you have provided the, an illustrative example of the donation that a company has particularly made. So there are, there are 3 companies that you have sort of put in there as an illustrative point. My question, however, is on one of the points that you sort of made. The leverage difference between politically connected firms and not politically connected firms seems to be very high. That's one question. I mean, this is there in your presentation as well, in the column chart that you showed us. Yeah, if you could go back. No, the column chart, the graph. The graph.
Yeah. Yes.
Yes, this is very interesting. And it seems that companies that are not politically connected are not at all leveraged. Not at all leveraged. The numbers.
Yes, in our study, I'm telling you, in the literature, we got that mostly the regulatory firms, which are mostly regulatory influenced or regulatory sector firms, they have, in our sample, we got those firms are highly politically connected. Basically, the cyclical sector firm like steel, mining, constructions, telecom. That's why this kind of figure come. Because if you see the consumer sector, we hardly find any firm which belong to the consumer sector, they are politically connected.
The point I was trying to make was this, that there are several large conglomerates in the country that make political donations.
Yes.
That may or may not make them politically connected. This is something to be tangible about, because you've defined politically connected company in terms of 2 manners. One is promoter and the other is donation. I understand that. And there will be several large companies where the connectivity through the promoter cycle will be, the promoter channel will be very hard to establish. And there, I think Dr. Dixit also had a good, her question was also ranging from there. But many large conglomerates in this country they make routine donations and they make it to all parties. I'm just trying to see if size was a major factor here. So you will have small companies which don't take leverage and therefore are also not in a position to make these cases. So it will be interesting. Here's my suggestion. And for figure 1 and figure 2, if you could see if there is some explainability which is by size of these companies. The balance sheet of a large company allows it to make political donations, and those political donations are made across parties. This is one sort of question. The other thing was, I would also suggest if there were, and what is also interesting is we all know over the last 10 years, we've had this leverage cycle that has played out in the Indian corporate universe, as you can see it here. Yes, it's also visible in your chart that corporate universe took high amounts of leverage, led to the twin balance sheet crisis, and over the last several years, now this is, and good, you finished your data by 2019, but since 2015 there was a deleveraging cycle. We do not see that happening for the non-connected firms at all. That is also something interesting as to, okay, these companies were not politically connected, but were they not in the in the banking cycle, in the credit cycle? It seems that is not coming out in the data, at least. This is something to sort of ponder. You have this very clear trend that is available for politically connected firms, and if you ask me, if you do a similar analysis, just leverage for, and we do it all the time, that we show and that overall leverage across the Indian corporate universe has been coming down. I see that. But then I see in your example, the non-connected firms, where I don't see the credit cycle at all. And also, just for clarification, Kaushik, how many firms are there out of the 1800 in the politically connected firms?
20%, sir.
20%?
Yeah.
And what portion do they have of the overall, you're doing by size, right? Let's say by size, what will be their revenue contribution?
Okay, I'm telling you, 20% is the overall political connections, 13% connections via promoter channel, 70% via donation channel. Okay.
And what will be their revenue share?
In an average, 200 crore in Indian rupee, 150 crore, 100 crore.
No. Let me explain this. You have a total universe of 1800 companies.
Right.
In any one given year, you have a percentage, which is say 20%, which is say about 360 companies which are politically connected. The rest aren't. 80% of them aren't.
Right.
Any idea of the revenue split of the
I mean, revenue or sales growth of those firms?
Not growth, total sales. I just want to understand these companies by size, because what I'm worried about in this analysis is you might be confounding size here. I'm just a little worried about that part of the analysis.
Yes, sir. I'm telling you, it's a very good question, sir. In other paper, in my thesis, I run a farm size effects explicitly and run a similar kind of model.
Okay.
Even though the larger size farms, they have the tendency to connect via promoter channel, not via the donation channel. But the small and mid-sized firms, they have the tendency to run by donation, but there are certain exceptions of that. If you ask me, I'll name those groups. Even I'm telling you, as you mentioned, that there are some influential business house in our country. They hardly bother to pay any donation to the political party because their promoters are highly connected. They don't need to pay any donation, or rather they don't disclose the donation in the public domain. But small and mid-sized firms, they used to, on a regular basis, they used to donate to the political party.
No, I'm making a different point. Kaushik, point taken. I mean, what you're saying is, I take that. I'm just trying to understand what is the revenue share of politically connected firms versus non-politically connected.
Okay, I have to check.
Just think about it.
Yeah,
because, here's my point. You have 80% of companies which are not politically connected.
Right.
And then, let's say overall leverage in the system, not as a ratio, overall debt in the system is 100. Now, if there is a linear sort of relationship, then you will expect them to have 80% of the total debt also. Right. But then you have made a point that politically connected companies take more leverage. that it's coming out quite significant for you, the leverage.
Yes,
ratio.
yes. Yeah.
How much is the question? It is good to show, it will also help you make up an argument in the paper. One part you made is, yes, leverage is a significant variable, but you might want to qualify it by saying, out of your overall debt of $100, 100 rupees, these companies, which comprise only 20% of my universe, 20% of my 1800 universe, take up 40% of the overall debt or 50% of the overall debt.
Okay, okay.
And because they're politically connected, we see this very strong relationship. That might come out, because here in your leverage, there's hardly any leverage of the unconnected companies.
Okay, sir. Okay.
And then one other question, obviously this is something you might want to do. You have data over 10 years.
11
right?
years. 11 years.
11 years. Yeah. 2019. Yeah, correct. 11 years.
Because before the data was not there. Too much of data we haven't got. Yeah.
Is there, this is a question that might come out. Is there a structural break in the data? Because we've had a different government coming in from 2014 onwards, which is practically the middle of your data point. You can test it exogenously or test it, do a biparon test and see if you can get a structural break.
Yeah, it's a very good question. Actually, sir, I will do this because what happened until the electoral bond data is yet to publish, because there's a huge spike. I'm telling you, in 2018 and 19, that the quantum of donations, especially, significantly high. There's huge abrupt changes and there is a huge transformations. And the electoral bond data until come into the public, which introduced in Finance Bill 2017, and there we can, it's a good suggestion, sir. I'll definitely work on it. And after that, we can make a structural break of this, maybe in pre 2018-19 and post 2018-19.
You can do that. If you do it exogenously, you can test that, because that will help you test the advent of electoral bond data. And the other way I'm suggesting is, look at the 11 years of data and see if you can get an endogenous structural break.
Okay.
That's also possible. See, electoral bond data allows anonymous donations. So naturally, there has been a big jump on that front. Makes sense. But it'll be good to test it when the data comes. But till then, you might want to, also want to look at it endogenously. Other than that, yeah, if you want to really take it forward in your thesis, you might want to you have 1800 firms. Okay, and 20% of them are politically connected. Why don't you find a propensity square match? Find companies of similar size, similar companies in other metrics. What is it that differentiates a company with politically connectedness, versus other? Just try and do it. You might want to explore a propensity square matching.
You're talking about the Mohalanavis method and nearest neighbor matching, all these methods, right? Different.
No. I'm trying to see, just find companies where, let's say, company C1 is politically connected. Try to find another company C2 in your entire universe, which is very similar. You can define the metrics, and the simple way is you can take multiple indicators and see how they are from a distance metric. You can have a Euclidean distance in n space. There are several ways of finding out propensity square maps. Just try and see any company which is very similar but not politically connected, and you can check performance. You can see, not just leverage. You can see, because here you've taken what happens when leverage increases, but what about performance?
Okay.
I'll stop here because there are two other papers, but good paper. Thanks a lot, Mr. Ganguly. A pleasure, looking at this paper. Very interesting analysis. Thank you. Thank you so much.
Thanks.
Thank you. Could we go on to the next paper now, please? Okay. So our next paper is COVID-19 pandemic, optimal lag determination, and intraday range volatility, empirical evidence of top 50 stock scripts from the Indian stock market, and it is by Susanta Datta. Mr. Datta?
Yes, sir.
Could you start, please?
Yeah. Just a minute. Yeah.
Thank you.
Could you please confirm whether my screen is visible or not?
Not yet. No, not visible. Yes.
Visible?
Yes. Now it's visible. Yes.
Okay. So myself, Susanta Datta. At present, I'm pursuing my PhD at Mumbai School of Economics and Public Policy, and I'm also serving as an assistant professor of economics at R.K. Talleja College, Ullasnagar. So my topic is COVID-19 pandemic, empirical evidence of top 50 stock skips from India stock market. But I'm not able to go to the next slide. So why?
You might want to put it in presentation mode first.
Yeah. So stop. Just a minute. Stop here. Share screen. Yeah. Then share. Yeah. Now it's working. Is it visible now?
Yes.
Okay. So this is the outline of my presentation: background, literature review, motivation, objectives, research methodology, then empirical findings, conclusion, references, reviewers comment, and if time permit, because since I'm dealing with 50 strips separately, so it involves huge table, at least taking more than 1 page or 2 page. So as and when required, I will refer to that, and I haven't incorporated into the PPT, but definitely I will show you if time permit.
Mr. Datta, I have only
so-
one suggestion to you. Mr. Datta, I have only one suggestion to you, as Dr. Dixit rightly pointed out. Kindly spend the majority part of your paper on the work that you have done and discussing the results.
Yeah, sure.
Thank you.
So, just for a very quick review, so it has completely disrupted economic condition, and already different literature has suggested effect in different sector. However, in this paper, I am focusing on stock market, and already pandemic negatively affected stock market return, along with increased volatility, spillover in stock return, and Banerjee and Chauhan has already confirmed that recovery was even quicker than earlier crises, including dot-com bubble and other financial crises. Okay, so let me skip that because these are all the initial findings within 6 month findings. Different literature has used different methodology also. However, neither of the literature has incorporated range volatility, which is very crucial measure of volatility during any turbulent time crisis period, and particularly for the economic crisis also. So what range volatility actually consider? It actually consider the high intraday high and low differences. Okay, so Parkinson 1980 first used it, and later on Peter Moner in 2012 and 2016 paper confirmed that range gauge actually outperform as compared to the return gauge volatility models. And later on, our paper also incorporated that aspect, and with reference to 11 sector from the national stock exchanges. So I have presented that paper in last year conferences, and if I recall correctly, that both CGM Ruchi Chohin madam and Discussant GM Probasrat sir, they have advised me that at present SEBI is monitoring and regulate stock market at the scrip level, not at the sector level. So that is the basic motivation. And in our last paper, we have already established that range volatility outperform as compared to return-based volatility. And not only that, using DCC range, we have also established that out of 55 pairs, 50 pairs confirm that there is a evidence of spillover. Now motivation. So this is 1 second. Extension of our earlier paper presented in last year conference. So at present, SEBI regulates and monitors market surveillance at the equity scrip level and not at the sector level. And basically, I have tried to do some alternative approach at the scrip level. Now, in addition, these are the innovation I had tried to incorporate it in the literature in terms of determining the lag length due to 3 reasons. First of all, optimal lag length actually help us to understand at what extent previous price movement influence the daily price movement and what would be the possible trade-off between holding and position during the trading hours. and it is important to a layman also who don't understand fundamentals and technicals during trading. Secondly, it will help us to compare, to develop a parsimonious model and compare different volatility models given the optimum lag length. And last but not the least, categorization of stock can be made across different segments, sectors. Now, objective is basically to identify optimal lag length in order to categorization of selected script.
Mr. Datta?
And carrying out comparative performance of selected 50 script. Now, this is the research methodology. So, hello?
Yes, yes. Kindly go on.
Am I audible?
Yes, yes. Kindly go on.
Hello?
You
Yes,
are.
Am I audible?
Yeah.
Yeah. So, unit of analysis at the steep level. Shall I continue?
Yes,
Please
please.
continue.
Hello? Okay.
Kindly continue. Kindly continue.
So, unit of analysis at the steep level for 50 for for open, H for high, L for low, and C for close price. I have considered for 24-month daily data starting with December 17 to December 2019 to December 15, 2021. Methodology part is concerned, standard guard estimation of guard chain, range guard model, and in sample for estimation and out of sample for position of 50
disable your webcam
across different sectors. Sorry, okay, disable. Achha.
Your bandwidth is pretty low. Disable your webcam and speak now, please.
Yeah. So, research method, descriptive. First difference, and here I have only considered intraday open to close return, not the previous day close to close return. Okay. So, at the next level, these are the descriptive statistics I have used. These are the diagnostic tests I will show you later on. So, hence I am not explaining here. And how to determine optimum lag length. So, from the 15th lag, I have selected the based on the minimum AIC criteria, the optimum lag length is determined, and then it has satisfied that there is no Q of P star. Then second is, but there should be autocorrelation in the squared error term. And this I have checked through Arch model whether Arch effect exists or not. Now this is basically the specification. So what I did here, I term in the Arch model. So instead of residual square error square, I use Parkinson volatility proxy, and this is the Parkinson volatility proxy, which is nothing but log of HT minus log of LT divided by 4 log of 2. So now this is important. So 75% sample I have considered for in sample estimation, and 25% sample I have considered for out of sample forecasting. And I can reported root mean square error value also for comparing both the models. Now look at the green and red colored coefficient. So what is the basic idea? The basic idea proxy in the Garch model, then your beta I coefficient will increase. So that is the reason it is a large blue coefficient, and beta J coefficient should decrease, and that is the reason it is showing a small beta J. Okay, but subject to the fact that your beta I and plus beta J should be lesser than 1. And out of 50, we have received 48 number of cases. The result is satisfied. At that, so hypothesis 1 is estimated beta I and beta J should increase, and beta J coefficient should decrease in R-gauge model as compared to estimated gauge model. Next one is R-gauge outperform as compared to gauge, both in sample and out of sample forecasting. So now let me move on to the my results. So the first figure 1 talks about both daily OHLC price movement for Nifty 50, and the next one is VIX India movement. Figure 2 represents separate 50 OHLC price movement. So at the level, so figure 3 represents the open to close return. So it takes too much pages also. Yeah. So figure 3 represent all the first difference open to close return for all the 50 script, and all the script actually showing that there is a stationary. So hence, since price data following a random walk process, we prefer to consider open to close return, because we can't work anything on the data which is following a random walk process. So that is the reason I have considered return. That means the first difference for modeling volatility. This is the description I have already mentioned. Yeah. Now this is related to. Now this is related to the descriptive statistics. Okay, so descriptive statistics: mean, median, mode, mean, median, maximum, minimum, standard deviation, skewness, kurtosis, observation for all the 50 script. Then next table, table number 3, the JB test, Jarki-Bera test for normality, ADF test at the intercept for stationarity, PP Phillips-Veron test at intercept for stationarity, and UD-max and WD-max for stability. That means whether there exists any structural break or not. So now at the next level, this is the estimation for optimal lag length. So for all the 50 script, I have calculated the optimal lag length, and then I had given the Q statistics along with probability, its square, the Q statistics along with probability, and the Arch-LM test, Arch-LM F statistics along with probability. Yeah. So now at the next level, this is the categorization matrix of 50 script based on their lag length, and this is the main table which actually represent both gauge as well as R-gauge result, and I have showed that. Yeah, and this is the last table, table number 7, and it gives lag length wise RMSE of gauge model as well as R-gauge model. Now let me return back to my presentation. So these are the gist. Sorry, just a minute. Yeah. So for positive return, and so as far as mean is concerned, there are 4 positive return and 46 negative return out of 50 script. Medium 3 positive and 47 negative. All maximum gives positive value and all minimum gives negative value, and all standard deviation give positive value as expected. And if you look at mean and median value, so similarly we got positively skewed distribution in 42 number of cases, and in 8 cases we had negatively skewed. And for all, kurtosis is greater than 3, which shows that non-normality and leptokurtic distribution. Now this is the summary result of mean and median. So green color shows positive return in terms of mean as well as median, while red color shows the negative return. Only for Grasim cement industry, we have positive mean but negative median, but otherwise both mean and median are same for rest 49 number of cases. Yeah. Now next is skewness. So 42 number of cases we have positively. So green color represents positively skewed and negative color represents negatively skewed distribution. I don't know why. Next, okay. Now JB test for normality. So for 50 cases we have rejected JB test null hypothesis at 1% level. So all 50 stripped are non-normal. All 50 stripped are stationary according to ADF test and TP test for stationarity. But there are stability issue for 7 cases. UD max is rejected for 7 cases out of 50 and WD max rejected. So in maximum cases, there are 11 cases are there where stability of the model is an issue. However, that is the limitation part of that research, because we haven't considered that, because we have very small range of data available to us, and subsample level analysis is not possible for at each and every company level, given the limited time available to us.
So that I need to wrap up now.
Sure, ma'am. Now, empirical findings. So these 11 cases, there are stability issue, but remaining 39 cases, that means green cases, there is no stability issue and there is no structural break available. Now, this is the important finding. So lag length wise, we have seen across different sector, we have 13 strip at lag length 1, 8 strip at lag length 2, and 8 strip at lag length 3. So if you look at out of 50, 31 strips showing that within 3. So within lag length 1 to 3, you have representation of 31 number of strip. That means if the intraday volatility is much more higher, range volatility will give you the best result. And I will prove it at the last. So now, because of introducing intraday range, in 45 cases, beta I coefficient has increased. Okay. And in 48 cases, beta J coefficient has decreased. As mentioned in my previous slide, if you recall, now best performing model out of 50 based on minimum AIC criteria, so 48 cases excluding Bajaj Auto and excluding Hindalco, range got outperformed as compared to the normal standard Gauge model. Okay. Now, sorry, just a minute. Yeah. So best performing model, and next, this is Argach is better as far as RMSE, that means out of sample forecasting. So 30 strips showing that range Gauge is better as compared to standard Gauge model. So I have already explained everything through different tables. Now coming to the conclusion part, I had tried to develop an alternative approach from regulators' perspective, extending our previous paper from disaggregate level to the more disaggregate level with the basic motto to ensure better market surveillance strategy in order to regulate and monitor existing strip-based market surveillance strategy by SEBI India. Accordingly, OLAC data I have used, and already I have mentioned whatever I have done through objective. Categorization has already been done for as far as optimum lag length is concerned, and comparative analysis has also done for 50 stock for other estimated results. So our empirical findings confirm that range-based Gauge model not only captured true intraday fluctuation during the turbulent crisis time period, but also true intraday volatility due to the outbreak of COVID-19 pandemic. So that is our contribution, and this result also confirmed with Peter Monar as well as our previous paper. So such an alternative approach will definitely help to the regulator to review the methodological aspect of daily review of price band, because it gives you a lower circuit and upper circuit. But how do you derive from the web? I haven't received such information that what is the calculation criteria. In majority of the cases, it is it seems like 5%, 10%, plus minus 5, 10, 20%. But on what criteria that SEBI is determining that lower circuit and upper circuit, I haven't seen any plausible explanation for that. And considering optimum lag length will be a better alternative according to my understanding. Now, these are the references. So, a reviewer's comment.
Thank you, Mr. Datta. Thank you. Your time's up.
Yeah, just madam, 1 more minute to respond to the reviewer's comment. So, the first 1 and 2 comment, it is nothing but actually I had represented data up to 3 decimal point. So at 4 decimal point, we have all the positive value. So the point raised by the anonymous reviewer of 0 values, That problem is basically a reporting problem because of the large data, large table, I have limited to 3 decimal, but at 4 decimal, all values are positive. Secondly, I have taken the lag difference to calculate the return value, but I haven't multiplied by 100. That is another reason. And the last point, what is the regular rationality behind selecting the Nifty 50 stock? Why not Sensex 30? So because Sensex 30 majority stock are the subset of Nifty 50. That is point number 1. Point number 2 is the market capitalization of Nifty is much more higher as compared to Sensex 30. And the third point is that it is an extension of our previous paper which deals with sector level. And according to the regulators' advice, I had made that attempt. Okay, so thank you very much for your patience hearing. I welcome your feedback and comment.
Dr. Dixit, for your comments, please.
It's a good paper. You had used a very extensive econometric methodologies, and you are telling that it is a range-based volatility is a better estimate of volatility, and you are giving much of the literature review about it also. But I think there is a contradictory view also about why range-based volatility models are not good. So when you are writing something, maybe a reference could have been made to that why it is not good also. There is a negative side of the using the range-based volatility models also. Probably you could have referred in your literature review somewhere that there is another side of the picture also. Mostly, I'm not commenting on the econometrics part of it, but when we write introductions, introduction is what? Introduction is what you want to convey, what you are going to do about in a paper. What is your point of view? How you are going to approach? But what I find in your paper, it appears to be a compilation of the various studies. Every sentence is being quoted said by somebody. Somebody has said this. Somebody has said this. It appears to me like a mini literature review only. So probably we can start writing in the introduction part what you want to say. Whatever others are saying will be very well covered in the literature review. Not even the introductory part. Even when you selected the data, that data is also you are quoting somebody. If I can tell you, the data is also you're telling because so and so has taken this data. I am taking, you could have referred it like that. I have taken this data, similar set of data has been taken by someone else also. But writing that I am, this data has been taken and quoting some other author, I didn't feel it a proper way of writing that your data, your methodology, your introduction. Maybe we can improve upon that. And third point is when you're comparing that I am saying range-based volatility is a better model, I think it would have been more appropriate if you could have made comparative study about it. How the other model is giving the values, how your model is giving the value, and then tell that it is a better method of estimation of volatility. Since you have extended this paper, whatever the comments have been given in your previous conference paper, you have incorporated some of the points and you have given this paper. I'm having a long list of observations, but due to the paucity of time, I'm curtailing my comments. One more thing I would like to say that if you are telling that this is a better method of estimation of volatility for a regulator to impose the circuit breaks, I think you could have elaborated a bit how it could have been used, because I can understand when I calculate volatility at the script level, then I know when it is jumping a point or moving down a point where I had to put a circuit breaker. But when the same script is a part of so many indices and so many other sectors, how you are going to estimate the circuit breakers for that? Or maybe whatever is your thought process could have been a bit elaborated in that, would have been more useful. Now I give it to Tirthankar sir to comment upon the econometrics part basically.
Thank you, Dr. Dixit. You mentioned many of the points I also was finding quite interesting here in the paper. So, Susanta, my questions to you would be very quickly. When you say range-based volatility models are superior to the normal volatility models. How do you exactly test that? You've said you do it through RMSE. Can you explain that to us, please?
Yes, sir. Sure. Just a minute. Yeah. Sir, is that visible?
Yes.
Yeah, sir. So see, the thing is that just have a look on that. So Gauge model using open to close and range guard model using Parkinson. Okay.
Yes.
So whatever comparison I have been made, that is based on, first of all, subject to satisfying all the precondition like beta I greater than 0, beta ij greater than equal to 0, and beta I plus beta j they are lesser than 0, subject to satisfying all condition, and the parameter are significant. So all double star and triple star, I think that is showing here. And while we are comparing a model, so normally we use in terms of information criteria. So here I have used AIC criteria. So sir, for both the model along with the estimated parameters value, the value of information criteria is there also. So whichever model gives you the lesser value, AIC value or information criteria value, in sample estimation, we are considering that is the best model. So the thing is that even out of 4-5 model, we can consider based on the minimum information criteria value. So that is your estimation in the in-sample estimation. But out of sample forecasting, because what happened, the tail end for 25% data we are considering for out of sample forecasting. So in out of sample forecasting, normally people use RMSE and MAE. So RMSE is sufficient to compare that, and which model gives you the minimum RMSE would be the better one. That's the reason in sample 48 model, 48 cases, range volatility is good. But while I have considering dynamic forecasting, then that number reduces to 30. So that's the difference between in sample, because in sample consider 75% of that data, and I am running the same model for the remaining 25% of data, because I don't know.
Susanta, allow me to pause you, please. When you do out of sample forecasting, you're comparing with actual data?
Yes.
Yeah. Okay. Just a minute. When you compare with the actual data, what is your proxy for volatility?
Basically, here it is proxy volatility, range volatility, and for GARCH it is normal residual square.
No. You estimate your range volatility model using RGARCH, and then you compare it with actual volatility, right? To compare your RMSE values.
No, sir. In sample estimation, I am comparing with residual square of the GARCH model with the Parkinson volatility proxy. But for out of sample forecasting, I am using RMSE of both GARCH model as well as the RGARCH model.
So you're just saying that the RMSE of the RGARCH model is, please don't scroll. Thank you. You're saying that the RMSE of the RGARCH model is generally lower than that of the GARCH model.
Yeah. For 30 cases out of 50.
Okay. And does this mean that the RGARCH model is superior to predicting volatility versus the GARCH 1.1 model?
Sir, basic justification behind that, because while GARCH model do what? GARCH model do basically the previous year close to the next day closing. But in between, what happened? Opening jump, overnight volatility, everything is there. But RGARCH model actually consider the opening to close volatility, only the intraday volatility. So I have used here not the close to close return. I have used here in the standard GARCH model the open to close return in order to compare that.
No, Susanta, my problem is this, that you can keep having multiple proxies of GARCH models here and keep getting a lower and lower RMSE. For instance, if you subject an exponential decay parameter in your models here, in your GARCH model, you can manufacture the RMSE to go back to 0. You can easily
Okay,
get much lower numbers. That's one worry. The other, since I don't want to have a much detailed explanation here, I just wanted to understand, where have you used? So you made an argument that sector proxies are better than individual stock proxies. All right, where exactly is that being used? I didn't see that anywhere in the paper. You've shown that you've ranked stocks within sectors across optimal lag length. Understood. So you found out the lag length across each for each particular stock. That's fine. That's okay. And that is basically the lag length that gives you the optimal R-Garch model or the R-Garch model. How is this then used at a sector level? I did not see in the paper.
Actually, sir, that paper we have presented in the last year. So this year I had considered 50 strip because from the last year presentation I received that feedback. So I have replicated the same methodology in the earlier year on 11 sectors. If you want, I can send you the paper.
No. So my only question is that you mentioned that in your opening remarks that the previous commentary in your last year's paper had said that SEBI currently does market surveillance based on stocks and not sectors. And you are recommending that sectors are a better way to do it. I don't see anywhere in the paper that sort of coming out. This is observation one. Another observation is echoing what Dr. Dixit said. If you're saying that this is superior to what is being done currently, how, where, that part has not come through. Then, in other words, do the policy implications really follow? What to do about that? Another point is, why not use high frequency data? In other words, if the idea is to have price bands, and you pointed out that the current method followed by SEBI is something that could be improved upon, then why not look at realized volatility, much better proxies of data, or implied volatilities, or at least some of the highly traded stocks? One could look at implied volatility of traded options. And if you want to do a more comprehensive formulation, why not realize volatility coming out of high frequency data? Given the amount of data that we have today is all in the high frequency space, why would somebody want to do a range based volatility estimation? Another observation. And one more observation on the paper is, please go to the end of the paper where you have your charts.
Yeah, sir, which one? At the level or at the difference?
Yeah, so I had observations on both the set of charts, please. You've given OHLCs of 50 stocks just before that. Yeah, please stop. So there are these charts for 50 stocks, and the lines are all just stop. So they are just 1 minute, please. They are all overlapping over each other. There is no way we can know where is the range in these stocks.
Yeah,
I mean, to me, and I'm not got the best pair of eyes, but it seems to be like one thick line generally.
Yes.
And then I have questions on say Eicher Motors chart. Did it all suddenly go to zero? What happened to the stock price?
Yeah.
So something to look at, and unless
because due to the space problem, I understand what you are talking about, but while we have created that in Excel, so that time it is visible, but while we have reduced that size in order to incorporate in the paper, because there are restrictions on that also, and it is also difficult because 102 numbers of graphs are there. How is it possible to otherwise it will be more than 102 paper? I can easily understand whatever you have talked about. I will try to incorporate those things. Yeah.
My only question is, you don't need to show 50 charts separately.
Okay.
You don't need to show so many charts. And another thing is, on the second set of charts, please go to the returns.
Yeah, returns. Okay.
Yes, please.
Yeah. Yes, sir.
Yes, these are returns. Please.
Returns. Yeah.
These are just returns. They look stationary, and you said that they look stationary. and then you have done a normality test on them, a stationarity test on them. We know that prices are random walks. We know returns are stationary. That part of the paper is obvious. One suggestion here, it makes much better sense to plot what you're actually talking about in the paper, which is range-based volatility. There is no chart of range-based volatility. There is no chart of gauge volatility. If you would have shown that these, since you have calculated them in your work, if you had charted them for even a one or two representative stocks, that would give us a better idea in the paper. And you could have shown how, in terms of an RMSE sense, that a range-based volatility model provides you a better, because that's your takeaway, than a normal GARCH 1-1 model. Those are the observations.
Sir, one more point before we conclude this paper. I feel there is a good use of econometrics, a lot of data, a lot of observations, a lot of charts. But as in one of the previous sessions, the discussant said that the paper is successful if a person who is having minimum knowledge of these techniques could understand what you are trying to tell. I couldn't get it. Okay, means I can read the figures, I can read the points, I can understand as a researcher, I understand what the person is trying to say. But whether a person who is not familiar with all these techniques is understanding what the researcher is trying to tell through the charts and through the figures. So a little bit of inference could have been added after whatever analysis has been done.
I would agree. Okay, thank you, Susanta. Thanks a lot.
Thank you, sir. Thank you, madam, for your feedback, comment. Yeah, thank you.
Our last paper in this session of Evolving Market Landscape would be by Mr. Nithin Jose. The paper is titled "Is Cross Hedging an Effective Tool for Eliminating Investment Risk in the Indian Banking Sector?" Mr. Jose, are you there?
It's presenting physically.
Yes, please.
Afternoon. I thank SEBI and NISM for accepting this paper and giving us a space to present this paper. So the paper is titled "Is Cross-Hedging an Effective Tool for Eliminating Investment Risk in Banking Sector?" And the paper is forwarded by Babu Jose. Yes, the flow of presentation will be like introduction, motivation, literacy review is data and methodology, empirical discussion with a conclusion. And as an introduction, we can say that the banking sector, as we know, banking sector is supervised and monitored by government central banks. And the intention of that is to maintain a healthy and reliable modernized system for performing the core financial functions of the economy. And this makes the sector very attractive for risk-averse investors. But the efficiency of performance of the banking sector is highly influenced by many other factors like Indian competition, technology innovations, asset quality deteriorated, then demand for higher profitability, rising customer consumer expectations, etc. So these risk forces the investors to use different risk reduction techniques or more like derivatives for the purpose of hedging or for the purpose of transferring the risk from the risk-averse investors to risk-averse speculators. But the problem here is that there are only in the stock market. If you're looking at the stock market, SEBI has specified. SEBI has they have regulations related with what companies can have or what stocks can have futures with them. So there are guidelines related to that, and that limits the number of securities in the Indian stock market which qualifies to operate in futures. So the basic question here is that.
Focus more on the thing where you had contributed, like
of course, Yes, the question here is that what will investors do when they hold large units of stocks which are devoid of futures? So the option, the chances for the strategy which they can employ is that they can go for a strategy called cross-hedging. So in cross-hedging, of course, is a risk reduction strategy, which is by taking an offsetting position in the derivative contract with a different but related underlying asset. But the risk characteristic of the asset is kind of similar to the asset which we are hedging. So here, the small investors, shareholders can utilize this opportunity or invest in the banking stock. So the investors have these choices. The investors can use the cross-hedge with market indices. Investor can cross-hedge with sector index futures or single stock futures from the same industry or single stock futures from related or other related or unrelated sectors. So our study is aiming at evaluating the effectiveness of cross-hedging strategy, assessing the hedging potential of various cross-hedging avenues of different group of investors. So different group of investors here means on the short-term traders we are focusing, swing traders we are focusing, and also fundamental investors we are considering. And also we are planning to suggest a optimal cross-hedging asset for the investors for investing in the banking sector. So first, here the data which we have used, we have taken daily, weekly and monthly frequency data, 1 day, 5 day and 20 days data. The closing prices of banking sectors which are reward of futures. The banking sector stocks reward of futures are selected from Nifty 500 index and near-month futures of Nifty 50. Near-month closing price of near-month contracts of Nifty 50 futures and bank Nifty futures, then single stock futures from banking sector, which is also selected from Nifty 500, Nifty 500, and select the single stock futures from related and related sector also. I select the period is from 1st January 2008 to 31st July 2020. And the methodology is like preliminary analysis is the stationarity, testing of market effect, then the diagonal backcast model is used for the purpose of estimating the covariances and variances, then optimal portfolio discount, where hedge ratio and effective gains and hedging effectiveness is also estimated. So this is descriptive statistics, and we actually found that this is the descriptive statistics of price series, and they are not normal, and we are converted to the lag, and these are the, sorry, I'm missing some part of the screen. So these are the stationarity test results, and stationarity result states that yes, in level there is no stationarity, but there is stationarity, and we have tested the arc effect, and they will consider the arc effect. But in weekly also there is arc effect, and in case of monthly return series, arc effect is present, but except in case of monthly return series of Canada Bank failures. Then moving on to our questions, the first question is, does cross-hedging facilitates risk reduction for short-term traders? So we are using a daily frequency data in the banking sector, and this shows the optimal hedge ratio, optimal hedge ratios for short-term traders, and we can see that the column headings states about the cross-hedging assets, that is Nifty 50, Bank Nifty, and single stock futures from the same sector, which includes Axis Bank, Bank of Baroda, Canada Bank, Federal Bank, HDFC, ICICI, and many others. And here we can see that in case of Nifty 50 futures, Nifty 50 futures, the optimal hedge ratio is higher than the name hedge ratio. In case of Bank Nifty, the optimal hedge ratio is higher than name in one case. In other cases, it's closer to one. But in all other cases, that is when we are setting with single stock futures from a same sector, there is not the optimal hedge ratio is below 0.50 or closer to 4.50. And the results reveal that in the shorter horizon, the results reveal that the highest cross-hedging effectiveness which we can achieve is 36.57%. 36.57% when we are using a single stock future, that is BNB futures, for cross-hedging. In case of Bank Nifty, if you're using Bank Nifty futures for cross-hedging, then we can achieve a higher value of 35.09 or 32.63% cross-hedging effectiveness. And of course, we can see the other values here. Moving on faster, the second results include the optimal portfolio and cross-hedging effectiveness of swing traders in the banking sector stocks. And here, the first table is about the optimal hedge ratio, and we can see a huge change, that is drastic change. Like in case of Nifty 50 futures we are using for cross hedging, there's a huge increase in the hedge ratio, that is 1.41 is the hedge ratio here. And also the other hedge ratios when we are cross hedging with Nifty 50 is also increasing than the hedge ratio. In case of Bank Nifty futures, also we can see an increase. But in case of other single stock futures, there is the optimal hedge ratio is lower than the naive hedge ratio, and it is somewhat closer to 0.50, around 0.50, and the lowest optimal hedge ratio is 0.13. So moving on, the hedging effectiveness. Think about the hedging cross hedging effectiveness. I mean, cross hedging effectiveness of swing traders. We can see here that the highest cross hedging effectiveness is achieved, that is 45.07% when we are using PNB futures, and in case of Nifty 50 futures and also Bank Nifty futures, we can also see an increased cross hedging effectiveness, that is 36, 37, 31%, etc. But in case of some stocks like Axis Bank, Federal Bank, and HDFC Bank, when they are using these futures for cross hedging, the effectiveness is comparatively low. And the last session is about the fundamental investors. That is where we are using the monthly data for the estimation, and fundamental investors in bank sector. Does they achieve higher risk reduction? That's a question here. And yes, this is the hedge ratios. We can see that in case of Nifty 50 futures, the hedge ratios are the lowest hedge ratio in case of Nifty 50 is 1.20 plus, and it is experiment 1.38. In case of Bank Nifty also, it is higher than the name in most cases. But in all other cases, that is closing or just higher to 0.50. And the observation we can find here is that the effective gains in case of fundamental investors is that Nifty 50 gives a highest cross-hedging effectiveness of 40.21. The highest cross-hedging effectiveness which we can achieve in case of fundamental investors is 53.74% when they are using Bank Nifty futures for cross-hedging, and the lowest cross-hedging effectiveness is achieved when Lakshmi Vilas Bank is cross-hedged with Dixit Bank, that is 4.33% only. And yes, moving on, the cross-hedging effectiveness of bank sector stocks with related and unrelated stock. Just here we have taken banks, the related sector as finance service, and we have selected a particular stock, and we have seen that the cross-hedging effectiveness is lower compared to the other related and sector indices. In case of unrelated sectors also, we can see that comparing to the sector indices and related features, they are lower in value. So these are the major findings. That is, the first thing is the optimal cross-hedging asset which we have identified, which is providing the highest hedging effectiveness is Bank Nifty futures, and the hedge portfolio which we are constructing with Nifty 50 futures and underlying bank equity stocks provided a risk reduction of 43.10 to 53.74% for the fundamental investors, and the hedging portfolio with Bank Nifty or PNB futures show a sound risk reduction for long-term investors, that is fundamental investors, and the cross-hedging portfolio created with stock futures from the same sector shows the hedging effectiveness, a highest hedging effectiveness of 50.62%, and Nifty 50 futures and Bank Nifty futures shows an incremental hedge ratio higher than the naive hedge ratio. Another observation is that this reduction with stock futures from the same sector also has a significantly lower hedge ratio than the index futures we have selected. And the result of the study does not disapprove the observations of many others, and the risk reduction potential of the futures increases with increasing trading price and cross-hedging. Another important observation is that cross-hedging, of course, it can provide an effectiveness of 53%, but still cross-hedging does not outperform the risk reduction capacity of a direct hedge estimated by Susanta. Okay, these are the observations. Thank you.
Stop the
Dr. Dixit, for your comments, please.
Taken on good topic, but my observations are similar to the earlier paper, sir. When you are writing a paper, in the introduction part, you should write what you want to say, not the. It appears to me as a compilation of many quotings of different people. It is a part of literature survey, right? So in the introduction part, you should say what you want to say, what you are going to do, how your study is divided into different parts, what somebody may achieve, what are your objectives about it, what is the hypothesis about it. Even the result part, I think you are writing the reference. Preliminary analysis, at least it should be your original analysis, right? It shouldn't be quoted. You could have said, yes, somebody also has seen like that, right? You shouldn't quote it. It's your own analysis, right? Then one thing is, you have mentioned at page number 7 of your study that somebody has already done a similar type of study using the similar set of data. I can show you page number 7. The study investigates cross-hedging performance of banking sector stocks, doing so and so, using the banking sector stocks in Nifty 500 index. Laws and John Thompson, you are quoting. I don't know this. I understood that Law and Thompson has already done that study because you are quoting. So if it is already done, then what was the relevance of you doing? If it is not like that, maybe it is a way of writing which is not correct. So maybe because you are doing it and you are quoting somebody, then it defies the purpose, right? And one more thing, it's a good thing you are giving investors an option how they can hedge their portfolio, how can they optimize their returns. But it would have been better for you to tell that this much of your portfolio should be cross-hedged. Giving me, if you're telling me you should cross-hedge, you should have a portfolio having this much of this stock, this much of this derivative, this much of other. So then what should be the optimal mix of it?
We have mentioned that the hedge ratios.
Over to you, Tirthankar.
Thank you, Dr. Dixit. My views are very similar to what you said. I think, Mr. Josh, it would have made sense not to quote so many references all through your paper. I know it must be part of your PhD or something like that. You're full of the references. Yes, I agree. But for readers who have not read your paper earlier, they do not have the same familiarity. So it would make sense to, as Dr. Dixit pointed out, restrict the references to the, to the introduction and how you are generating the interest in the paper. And then you clearly just point out what are you trying to do and how are you trying to do different. There's a lot of good work in the paper, but it sort of gets lost because everywhere you discuss things, these references keep coming in. We did something, this is similar to something else that you don't have to do it. It just rewrite your paper a little bit and it will look much better. Also, the other point, I had a clarificatory question. Have you looked at liquidity? So it's possible that the optimal hedge ratio or the choices that you're providing, are they liquid enough for you to take large positions? One other thing that you've not done, and it might be worth looking at, is say you have a position of N in a particular stock, and you've said that what if the single stock future for that stock does not exist? Makes sense. You've then compared stocks and then indices and said what are the hedge ratios? Makes sense. What if that N ranges from say 100,000 to a crore, a larger number? Then the liquidity of your underlying hedge becomes very, very important. Just you might want to consider the size of your portfolio also, and just to extend this analysis. Other than that, I would just say rearrange your paper a little bit so that it brings out the points quite clearly. Other than that, all sort of good work.
Thank you so much.
So that sort of brings us to the end of this session. Thank you, Mr. Josh. We've had 3 papers. One paper was on political connected companies, where Mr. Kousik Ganguly of IIT Kharagpur gave us a good sort of analysis, looking at 11 years of data as to how things change for companies that have political connections and the companies that don't. How do you know companies have political connections? 2 ways. One is, do they have promoters that have political connections, or these companies make donations? And pretty interesting amount of work that is not generally easily available in the public domain. So kudos on that front. A lot of good work. And how these companies then behave in terms of financial performance. How do they measure financial performance? Leverage, their cost of capital, cost of debt. So good question there. The second paper that we had was, there's this problem that one typically looks at about what is the optimal estimate of volatility of a particular stock, and what kind of models should be used. And this is an open question. It's been there for several years, and better and better models keep coming in. And on that, Mr. Susanta Datta told us that range-based models are something to be looked at. Something, even though the first analysis of range-based models was in 80, Parkinson, but they do have their use and they are quite interesting. And the third paper was from Mr. Josh, Nithin Jose, that was just done, which said, if you have a stock, great. If you have a stock which has derivatives, then in difficult conditions like we have today, you would want to hedge that portfolio. That's good. But what if you don't have futures or derivatives in the portfolio of your stocks, in the stocks on your portfolio? What do? Then you employ a technique called cross hedging. And then he goes on to explain several ways in which proxies for these stocks to be used as cross hedging could be employed. So all in all 3 papers, very good thought-provoking papers. Many of the assessments that came out of the paper were non-trivial and therefore made us think. And I thank everybody for the papers, and Dr. Dixit for excellent discussions. Thank you so much. And with that, I take it to you, Ms. Shukla, please.
Thank you so much, sir. As sir rightly said, these papers very well shed light on the changing contours of the ever-evolving markets. I'd like to extend a sincere thanks to our Honorable Chair, Dr. Tirthankar Patnaik, our discussant, Dr. Deepali, Dixit, all paper presenters and all attendees for making this such a wonderful session. It has been such an honor to be part of this session. I now like to call Dr. Jain to present a total of appreciation to Dr. Dixit. Dr. Patnaik, once again, it's been a pleasure hosting you. You wish you could be with us in person.
Thank you. Thanks a lot.